Hi and welcome to the video. Today we're looking at the best long-term investment plan. That's the power of compounding. Let's see how this can really make your money work for you. So I'm going to review the three main indices that we have. I'm going to review the FTSE 100, the S&P 500, and then my favorite, which is the all-world indices with the ETFs that are available on all three of the platforms that I recommend in the description below. Be sure to check those out. Before we get started, be sure to hit the subscribe button and the notification bell. That's going to not only help you see the next videos as I release them, it's also going to help this video to reach more people, and I just want to help more people get started with investing. So let's get into it. So let's just start with the FTSE 100. The FTSE 100 is the top 100 companies in the UK, and that's based on an index. Like I say, the top 100 companies. We're going to review here the historic performance of that. We go look over the last 20 years of history. That gives a very good average return. Over the last 20 years, you can see we have a compounding annual growth rate of just under 10%. We use 10% for a very good average. And when we look on the charts over the last 20 years, you can see it's had a very nice, steady upward movement. And if we took an account, for example, this is in euros, 10,000 euros, that grows very nice and steadily, consistently over the last 20 years, up to the region of 65,000 euros. And if we look at the average returns over the last years, the last year has been specifically good. Annualized is a nearly 18% return just the last year alone. But you can look over history to take a broader review of how these have performed. Even the last 10 years has performed 11.5% annually every year, or even the last 20 years, like I say, just shy of 10% return. That's a very good return, making your money work very hard for yourself. And now we're going to take a look at my personal favorite, which is the SPDR MSCI World ETF. This had a very similar understanding. You can see this was created back in 2019, had a very good history. Yes, the history has been a little more volatile than the FTSE 100 we just looked at, but the growth is far, far higher. We can see here an annual growth rate is just over 10% a year over the same 20-year period. Gives us a slight edge on the FTSE 100. We can see even there are good years, there are bad years, but as long as it's consistently performing over the longer term, that's why it's a long investment plan. The longer the term, the better it will work for you. Slowly, allowing compounding. That means earn profit on profit. It's a great way to make your money work for you, so you're not physically working for your money. And for my final small comparison, I'm comparing here the S&P 500, that's a US index in the top 500 companies. My favorite, which is the SPDR, the World ETF, and also the FTSE 100, just for a comparison on all three there. Gives you a nice idea that over the last 20 years, these have all performed exceptionally well. The US S&P 500 has outperformed all of the others, but it has also been more volatile as well. So depending on your risk outlook, but the longer term, they are all extremely good. So we're going to look here at how the three have compared over the last 10-year period, just to give a very realistic comparison of the three indices. The FTSE 100 from the UK, the S&P 500 from the US, and the All World Index as well. And here we can see how they vary in the way they perform slightly. But what this is about its profitability and its growth over years. So if you go over a 10-year period, you can see the FTSE 100 just has the edge over the others, which is very surprising. But that has been the performance in the last year, which has given it a slight edge. Now, the power of compounding cannot be underestimated over the long term. That is allowing your money to grow and grow and grow. So that's making your money work much harder than you possibly could. Let your cash working for you gives you much more time freedom. Let's do a realistic example with the calculator here. And we're going to take a simple £100 with a 10% return a year over 5 years. That allows it to grow very nicely to £164. That is just one-time investment at the beginning, leave it. You can see how the interest starts to accumulate more and more over the years, as in the chart here. But let's then step this up. Let's step this up to a 10-year review. So we're going to keep everything the same, £100, invest at 10% a year, and we're going to see how that looks after 10 years. That gives us a huge growth, total value of £270. You can see in the chart here, the yellow element is the growth of that investment. That is starting to get even bigger. So that is now outpaced your original investment in 10 years. That's the power of compounding for you. So it's a long game. Allow time to grow your account. So let's step back and say you want to regularly invest. Let's take a £100 deposit at the beginning and you want to invest £100 a month at the end of the month on payday, for example. And you can start to see how this really steps up the way your compounding can work. So yes, you've deposited over 10 years a lot more money, but your future growth has also grown a huge amount more. Your total interest earned over that period is nearly the same as your investment at over £8,000. You can see in the chart it starts to grow very rapidly. Then we can step up the years. See, again, allowing your money to grow over the years. Let your money do the hard work. You just make a small decision at the beginning to invest very regularly in something very stable. Looking at the past history, it's not a future guide for growth, but it gives a very good benchmark for what you could realistically expect. We're going to take this over 20 years now and look at just how much this starts to grow. This is starting to grow more than the first 10 years. Then we see the interest earned over 20 years, over £52,000 on the same amount of money. That's double what you initially put in. This is why the growth curve you see here is so impressive. Your interest, growing on interest, that's compounding, is working far harder than the money you're putting into it. That's an amazing amount of return you're looking at. And then we're going to step this up for the young folks. They've got more years to look forward to for investing. So let's try a huge 35 years. See how this really looks. You're going to be impressed. If you just start from the age of 20 years old, by the time you're 55, you're going to have £382,000 in your investment account. That is sorting you out very nicely towards your pension fund. And you can see how big your compounding effect is if you start early as possible and allow the years to do the hard work. I'm just using a very conservative 10% return history. You've seen the evidence I've just shown you. This is more than possible. So this is why it's so important. Get started as early as you can. Let time and patience play your game to building your wealth and your financial freedom. And don't forget to allow your capital to grow even better. Make sure you make the best decisions to invest it tax-free. That is really important. Not only saving and allowing your money to grow, but when you do decide to withdraw the money later on as your pension or to save it for buying a house or something like that, when you take your capital out, you are then subject to taxes. Therefore, making decisions to save your money tax-free is the most important decision. Keeping the money to yourself and not paying it away to the taxman. Check out my other videos which show you the best ways to save tax-free. Make sure you maximize your ISA allowance, particularly this year amongst any other. You only have £20,000 annual allowance in your ISA for stocks and shares. Make sure you maximize your allowance and make sure you keep your investments tax-free. And if you haven't started, start your SIP, your self-investment pension plan. When you make your deposit, so let's use this same example. We're going to take this £100 a month. When you put that into your own SIP and invest in one of the ETFs as you choose, they all perform about the same. the government give you a 20 to 25% top up. That's done automatically for you by the investment platform. That means you gain another 20, 25% bonus into your account before you even get started. That allows that to grow as well as your own money. That has to be a sure win to get you to financial freedom sooner. So that's all I've got for you for today. I hope that's been useful. If you can please give me a thumbs up and share this with your friends. Let's get investing. Don't forget to hit the subscribe button and the notification bell. And until next time, take care.